So this chapter covers capital investments. First part of understanding capital investments is to look at capital budgeting. So this is where you're kind of looking at the broad overview of all of the capital projects you are considering undertaking or have already begun the process of undertaking. You'll look at the entire lifespan of the investments, so there's no cutoff point where you stop looking at the cash flows and the benefits of the investment. You'll look from the initiation of the investment all the way through to the complete termination, and just like any typical budgeting process, it kind of serves as a plan for upper management. So there are 5 stages to the capital budgeting process according to the book. These consist of these 5 areas. And you can basically sum these up by saying, look at the potential investments, look at whether or not it makes sense to invest in them, look at which investments make the most sense, and then go get the money needed to make those investments. So these are 4 different ways that you can look at capital budgeting and decide. These are basically ways of looking at investments and determining which investment is predicted to be the most profitable. We've got net present value, internal rate of return, payback period. I would say those 3 are the most commonly used, and then accrual accounting rate of return. And we'll talk about those individually. So for discounted cash flow methods, this basically just consists of looking at all inflows and outflows of cash and discounting them to their present value. So you're not worried about the difference in time value of money into the future because you're taking that into consideration, and this is going to give you a reasonably accurate view in today's dollars at what the cash flow from this investment will look like. So the required rate of return is used in discounting cash flows, and this is basically more or less the opportunity cost of investing in certain capital decisions, because these are kind of known alternatives, like, hey, I know I can go invest in treasury bonds and get a certain rate of return, so if I'm going to invest in something else, it needs to be at least this certain amount that I know I can get from this sure investment. And it's usually something that's a bit more concrete, like a treasury bond, not necessarily always that, because that is a very low return, but something that is predictable and gives kind of a minimum threshold when looking at projects to say, okay, well, it certainly doesn't make sense to invest this capital in whatever I'm investing in if it doesn't at least get me this sure investment that I could get elsewhere. So for NPV, or net present value method, you're basically just using discounted cash flows, combining with the required rate of return, and comparing those two to make sure that the current project that you're looking at, when you discount all cash flows back to their present day value, is that going to get you the required rate of return that you need in order to be, or is that going to get you the return that you're going to need in order to be above that required rate of return that you have? So this is again a 3-step model that your book has as far as net present value method. So you're basically going to get an overview of cash inflows and outflows. You're going to discount them, and it's, this table says, hey, look at a compound interest table. So basically there's plenty of tables you can look at that say, okay, using this interest rate, this amount of years into the future, what's the exact amount that I'm going to get back for $10,000? And it basically more or less discounts. You just have to find the row and column that pertains to whatever amount and interest rate you're looking at, and it will give you the discounted amount. Plus there's lots of interactive net present value calculators, or you can just do it in Excel. Finding the internal rate of return is just finding out whatever discount rate you would need to use for calculating the present value of expected future cash flows in order for your net present value to be zero. So basically, to have no cash gained in the investment, what interest rate would you have to use when you're discounting future cash flows back to their current value? And that will give you a rate that is known as the internal rate of return. And if you're using the internal rate of return method, again, and these all kind of are grouped together, your book distinguishes them, so we're covering them separately. But this is all kind of what you would do if you're doing an internal rate of return method. You're using the required rate of return, you're using discounted cash flows, and you're basically saying if the internal rate of return exceeds the required rate of return, then you've passed the hurdle. And it doesn't necessarily mean that you're always going to accept that alternative, because there may be other projects that you're looking at that have a better or more positive internal rate of return. So this just clears the hurdle to where if it was below that, you would say, yeah, it doesn't make sense at all to go with this project. And then above that is either go with this project or evaluate further, because there may be other alternatives that are even better. Yeah, I won't talk about the subjective decision your book has made to say a net present value is better than internal rate of return. They're very similar. And that last bullet point there is, or the last two bullet points there. If you've got a required rate of return that varies over the life of a project, net present value could be better. And if you have a high internal rate of return, then project reinvestment may not be a valid assumption. Now, sensitivity analysis is basically just looking at, if I make certain small changes, how much is the scenario going to change? So this is, again, we're kind of predicting the future for some of these things. So it's good to perform a sensitivity analysis at the very least internally, or thinking about it in your head, to think about, hey, these are the assumptions that we've made. What happens if one of those assumptions is slightly wrong? Is the overall decision to invest or not invest going to be greatly affected by something being slightly tweaked? And if it is, then it's very sensitive to differences in the assumptions, and you may want to analyze further whether those assumptions that you've made in predicting what's going to happen with this investment, whether those are actually as sound as you originally thought they were. Okay, so let's talk about the payback and discounted payback methods. For the payback method, this is a pretty easy one to calculate. You basically, are looking at all of the cash flows coming in, and you've got your overall cost of the investment, and you want to know how long, assuming you're taking all of the cash flows coming in, how long is it going to take you to get to the point where you have broken even on the project? It points out a few weaknesses here. Time value of money is not discussed. So, if you've got a payback period that's 5 years or 10 years long, you could have a very substantially different time value of money in that time frame, and you're not analyzing that at all with this method. You're basically just saying, hey, is it a short or long period before I'm going to make all my money back and can start profiting off of this investment? And sometimes that's important. If it's a cash tight business, and you're very concerned about cash flow, maybe it's super important for you to recoup the investment quickly and get to a point where you are bringing in additional cash in the very short term. This is basically just saying that it's a lot easier to calculate payback period if you know you're going to have the same amount of cash flows from the investment. It's pretty obvious. Again, the kind of opposite of the last slide, if you don't have even payments or you're not receiving even amounts of cash from the investment, then you can't just plug it into that simple equation. You've got to kind of just look at the cumulative effect of all the cash flows that have come in or are expected to come in. And it just takes a slightly longer analysis to get to the point where you want to get to. So for discounted payback method, it's pretty much the exact same as payback method. The only difference is that you are discounting all cash flows until you get to that break-even point. So, cash that you're getting 3 years from now is not as valuable or doesn't count as much towards paying back the investment because you're discounting that cash based on the time value of money, because it would take less money today to get to that amount of money in the future. So you're basically just using time value of money and plugging it into the payback method. So now let's talk about the accrual accounting rate of return. This is a fairly straightforward calculation. You just take the increase in expected average annual after-tax operating income and divide it by the net initial investment, and that gives you the average rate at which a dollar of investment generates after-tax operating income. When comparing the accrual accounting rate of return and the internal rate of return, you're considering accruals and taxes, which is good. You're not really looking at time value of money. And usually just that factor alone, while time value of money obviously changes the dynamic of doing the analysis, any type of sophisticated organization is going to use some capital budgeting method that takes into consideration time value of money, because it is can be such a difference maker looking further out than 1 or 2 years. Obviously, the further out you go, the bigger difference the time value of money goes. There are some advantages to the accrual accounting rate of return. You're using relevant numbers from the financial statements that you can easily see. They're easy to understand, assuming that you understand the financial statements. It also helps you to look at what the effect of the project will be on the financial statements. So obviously a CEO is especially in a publicly traded company, is always having to be cognizant of the effects on the financial statements, because that can dramatically affect stock prices and can affect investor satisfaction with your company. But the biggest one here that's a drawback is the time value of money. And so in spite of the benefits that you can see from a managerial standpoint, in terms of seeing things in a uniform way with the financial statements, um, this one hardly ever gets used because of the fact that it ignores time value of money, and the very same people that would benefit the most from using numbers uniform to the financial statements are the ones leading organizations that are sophisticated enough that they can't afford to not employ some capital budgeting method that talks about, or at least analyzes to some degree, the time value of money. Okay, relevant cash flows when making capital business or capital budgeting decisions. So again, when we talk about relevant costs or relevant revenue or anything relevant, you have to look at what's going to be different as a result of making the investment. So if you're considering multiple investments and they all have some element that's cash flow that's the same, that's irrelevant to making the decision because they're all going to be the same. So this gets a little bit complicated if you have several investments that are similar in a lot of ways, because you want to tease out all of the irrelevant information and narrow your investment decision to the areas that are relevant and different between the investments. So there are three categories of cash flows that we're going to look at, or that we look at in the budgeting, capital budgeting process: net initial investment, after-tax cash flow from operations, and then after-tax cash flow from whatever disposal value and recovery of working capital you have from the investment. So for net initial investment, you're looking at initial machine investment, initial working capital investment, and any after-tax cash flow from current disposal of old machines. So again, this is kind of the disposal side of switching off the old investment, or switching out of old machinery that you need to switch out of because of this investment. So the last component of the current investment kind of ties into the first component of whatever the new investment is. So they are a little bit tied together there. As far as cash flow from operations, you got after-tax inflows from production and selling of additional goods or services, or any savings that you have incurred based on investing in some way. And then you also have income tax cash savings from any annual depreciation deductions that are relevant to the investment that you are considering, be it new equipment or a new building, whatever it is that you're considering investing in, that becomes a relevant cash flow. And then we have, again, basically the disposal value, if there's any salvage value of machinery or whatever it is that you can get from selling off the capital asset that you purchased for the purposes of this investment that you no longer need, and also any working capital that you recover through liquidating receivables and inventory once the project is over that you no longer need. Again, this is this is kind of in relation to capital budgeting, and looking at it from the further up the managerial ladder to tying in capital budgeting decisions, decision making, and evaluating performance of lower level managers based on that. And obviously that's always going to be a challenge of how you set up the reward system in a way that motivates the lower level employees and their goals and desires, how those can be lined up with upper level management. So these are just a couple of components of managing the actual project. And so you've got management of the investment activity itself and management control of the project as a whole. These are areas that you can drill down into to analyze and maybe place reward systems within to try to align employees' desires with company desires. Post-investment audit is basically a way to tie some accountability back into an investment, rather than, once the decision has been made to invest in a certain capital project, and then just forgetting about it, because you've already made the decision. This is a way to kind of drill back into it and look at budgeted versus actual performance. See, again, kind of analyze the assumptions that you looked at in order to undertake the project and see if they were realistic once it's already done. So this, obviously, once the project's done, you can't really make decisions about that project anymore. But this does encourage management that is going to be involved in future projects to be a little bit more conservative in their estimates, because they know that just because they got a project approved doesn't mean that's the end of the show for them. They're also going to have to be looked at again to see if what they predicted to happen and the numbers and assumptions they used to get the project to get a green light on the project. We're going to look at back and say, was that really realistic? And obviously, you're going to tie performance evaluations to any of these things that we're drilling back into, so that we can, encourage good behavior, discourage bad behavior, discourage anyone from short-sighted, selfish thinking, even though it may seem like it will, be advantageous to them. If they have some accountability later on down the road throughout the life of the project and beyond, then we can do a better job of tying their interests and desires with the company's. I think something important from this slide to remember is that capital budgeting is not all science. There's art to it as well. As experience is accumulated in management, and they've seen the process happen many times, it's a lot easier for management to use their judgment and intuition to help analyze the decisions in the capital budgeting process, and obviously tying the company's strategic goals and the management's strategic goals together with some type of reward system is a good way to help managers take that into consideration when they're doing this capital budgeting. R&D investment's tricky because you have, as this slide says, you've got kind of a longer time window usually. So the budgeting process is usually staged. So there's stage 1, stage 2, stage 3 as the research and development process moves forward. This is kind of a tricky area when you're looking at trying to align management's interests with the company's, because if you have a project, research and development project that right off the bat's not going to yield any results for 10 years, and you have a management team that's eyeing retirement before the 10-year window is up, it's going to be hard for them to justify in their minds the investment, because for their personal opportunity cost is going to be a lot higher, because they will only see the costs of the research and development under their watch, and they won't see any of the real benefits until they've already got to the point where they're going to retire. So, stage in career is obviously a consideration to look at when you're evaluating the system of rewards, and if you're in an environment where you're trying to encourage research and development, or that's a key component of your business, That's one of the areas especially, or any other area as well that has kind of a long time window in the capital investment process. Those are areas that you want to look at some of these ancillary things like, career life of left of, management that's relevant to this project. Um, Anything that you can look at that is going to give you a better idea of how to predict the motivation that these management or middle management types are going to have is a good thing, because then you can use that information to develop systems of rewards and evaluations to try to encourage the behavior that you want to see. And then finally, this last slide is just kind of a way to apply the concepts of net present value and capital budgeting to evaluation of customers. Again, this is kind of when you're looking at the decision to keep a certain line in existence, or whether or not it's worthwhile to cater to a certain customer that's a problem. This would go into comparing customers and their value to the organization. And that's it for capital budgeting.